allow me to introduce our speaker for today, CY So. I believe many of you know who he is, and he is excellent lead trainer, and he's also a chartered market technician, CMT chartered holder as well. Now, he's also a certified master trainer of NLP, and CY is also a performance coach with extensive experience in coaching individuals with performance improvements, behavioral change, self-empowerment, and also personal breakthroughs. Now, his specialty is in trading system and strategies, trading psychology. So it is very relevant for today's topic and also NLP. So without further ado, please allow me to pass it over to you, CY.
Good evening, everyone. How are you doing? So today's topic is about trading psychology, how to deal with trading losses. Now, I believe many of you, you may have your trading system or your trading strategies already. However, when it comes to trading, we do know that losses is actually something that is unavoidable. So dealing with trading psychology is actually one of the important things that you must do besides having a good trading system. Okay, so when it comes to trading, most people talk about the winnings, right? How they make money, how they time their entry as well as exit, and how much they make. While very few actually talk about their failure stories, especially on their losing trades, how long do they lose their losing period, and how to cope up with it. Now, I believe today some of you here have many experience of trading, while some of you are just beginners who are just starting your trading journey. So regardless of what background or trading experience you come from, somewhere along the line in your trading journey, you will definitely encounter some major challenges in your trading, especially when it's related to losing trades, losing money, or even facing a period of losses and many other challenges. So in trading, it doesn't really matter if you have the best trading strategy or trading system, the best charting software, or even having the best new feeds, right? If you are unable to deal with trading losses effectively, you are unable to actually actualize the potential of your trading strategies. Why? Because when it comes to trading losses, right, especially the situation of continual losses, majority of the traders begin to start doubting as well as questioning whether their trading strategies still works or not. Am I right? So they will be beginning to, what they do next is they keep changing trading strategies and not following their original trading plan anymore. So do you face the same thing as well? And whether does this actually sounds familiar to you? If this is very familiar to you, type in I in the chat box so that I know you are actually in the right place and actually ready to learn what I am about to share with you later on. So by the end of this session, you will understand besides having a good trading strategy, why learning how to deal with trading losses is very crucial to your trading results over the long run. Okay, so let's get started. Now, of course, this webinar is for educational purposes only, just to give you a quick understanding and widen your horizon and exposure about knowledge in trading. Standard quick disclaimer, I give you a quick 5 seconds to look through it, and you still need to study further in detail and develop effective coping methods that actually suits you when it comes to coping up with your trading psychology. And I believe Ting has already introduced me. My name is CY. You can just call me CY will do. So this webinar will be organized in 4 topics. So the first topic would be understanding your trading psychology. I will start with the foundation first so that all of us can have the same understanding when what is trading psychology all about. The second topic would be understanding trading losses. Most people think that trading losses only limits to losing money, from your trading account. So in this section, I will highlight further in details the four main types of trading losses that most people feel in their trading. And the third topic would be the 5 stages of grief and loss. This is very important because when you go through trading losses, these are the 5 general stages most people will be actually experiencing. And lastly, I am going to share with you a little bit on the effective strategies on how to deal with trading losses. Once you are able to identify trading losses, once you are aware of the psychological process you are going through, then you need to learn how to deal with it so that you can actually get back on your feet, stand up, and then continue to move forward. So let's begin with the first topic about understanding trading psychology first. There are some foundations I need to build so that you are able to follow me better later on. There are some terminologies and words you need to know, and so that you will have a better understanding and a clearer picture about what trading psychology is all about. Before we begin, I would like to ask you one quick question. When you hear about the word trading psychology, right, what comes into your mind? And what do you think trading psychology is? You can type in whatever keywords that comes into your mind, so you don't have to worry whether your answer is right or wrong, because there is no right and wrong answer. Just type in whatever keywords that you know about trading psychology, and later on I'm going to give you a comprehensive definition about what trading psychology is all about. Because if you go through a lot of books in trading psychology, right, different authors actually define trading psychology very, very differently. So in the end, you may get confused. How come some author refers trading psychology with this, and some authors referring trading psychology is something else? So later on, I'm going to give you a comprehensive definition what is trading psychology all about. So I see some of you will put mindset, fear and greed, emotions, fear, doubt, strategy, emotion, control, mind games, discipline, state of mind that influence your action, fear of trading, FOMO, and managing emotions, your character or your reaction. Okay, so I believe some of you get some of the piece part and parcel of what is trading psychology all about. So let me share with you what is psychology first. So we remove the word trading psychology. Let's look at what psychology is all about. So bear with me a little bit, because this topic, when it comes to trading psychology, right, a lot of people who wants to find the best way in terms of trading the market. A lot of people wants to find the best trading strategies, the best trading system. So today I'm not going to talk about that, but I would like to talk about something that is soft skill besides trading system and trading strategy. Psychology is something behind that actually drives your success, because having a trading strategy and trading system is like hardware, and psychology is actually your software. So you need both in terms to drive yourself towards trading success, as well as achieving your trading goals over the long run. Okay, so I do my best to reduce as much jargon and technical words as much as possible. So try your best to understand. Okay, now when it comes to psychology, right, the whole domain on psychology actually study about these three main things only. Okay, and in fact, don't let this, although these three main things sound simple, right, you can still go in depth very much on each and every of these component. So psychology, these three things. The first thing is actually on your mind. Okay, whatever that is in your brain, right? We use our brain to think, and that is actually our mind. So our mind includes your cognitive processes, your thinking processes, how you process information. So that includes your knowledge, your mindset, as well as your thinking. The next component would be your behaviors, the things that you physically do. So it can be any actions or any activities that you do. So for example, you walk, you move, you eat. All of your habits are actually your behaviors. So behaviors are actions, things that actually you do. And the last component about psychology is emotions, the study of feelings or even emotions. So it's about how you feel about the internal events, which is something that is happening inside you, as well as the external events outside there. So how you respond to whatever things that is inside you, as well as the external environment. Okay, so can follow me? So to put it in simple words, right? The field of psychology is the study about these three main components, okay? The think, feel, and do. Okay, so simply speaking, you can remember this very easily, right? It's about how you think, how you feel, as well as what you do, okay? Think, feel, and do. Very simple, isn't it? So trading psychology, it's about what happens to your psychology when it comes to investing as well as trading. Okay, very simple. Now, let's look at what trading psychology is. You have already learned what is psychology. Now, let's look at what is trading psychology when it comes to trading. So again, the first thing, which is your mind, your cognitive and your thinking process. It's about how you think and how you analyze the market. So in order to think and analyze the market, what do you need here? You need a good trading mindset. You need to have knowledge that is related to trading and investing about the market. For example, technical analysis and fundamental analysis. You also need to develop trading strategies and more other things here. The next component would be your behaviors. So behaviors are the things that you do in trading. So it includes going through your checklist, your trading plan, recording your trading journal, as well as doing your trading execution. Now, I believe some of you did not, perform some of these, good practices in trading, right? Especially, going through your trading checklist as well as recording your journal. But it's actually one of the important things that you need to do in order to improve your trading. And the last component of trading psychology, as we know, is our emotions. So emotions are actually the responses that you feel when you trade the market. How you feel about yourself when you trade, how you feel about the positions that you have in hand, and how you feel when you have a trading profit and even trading losses. The emotions that running through you when you process informations or even news in the market. So here you can see that all of these three components, think, feel, and do, in trading psychology. You can go even deeper for each section if you're actually interested in it. And one very important thing you need to know about psychology here is that each and every component, the think, feel, and do, they are not standalone. Okay, they are not standalone. They are also not separate parts itself. Okay, you cannot separate thinking is thinking, behavior, and emotions standalone. Okay, because all of them are actually linked together. Now, it's important for you to understand trading psychology. If you do not know your psychology, you may be doing things blindly without having a conscious awareness. When you know your psychology, which means you know your thinking process, you are aware of your own emotions as well as your behaviors, you can actually re-engineer the whole process of trading so that you can see what went wrong and where and what specific areas you can actually improve in your trading. So let's look at the end result here first, which is your trading success, right? Everybody desires it, everybody wants it. And you want to have positive result in your trading, right? And you want to make money from trading. And almost everybody wants that, okay? Who doesn't want to make money in trading? So in trading, let me break this into three phases, which is before trading, during trading as well as after trading, so that we can see what are the things that actually you do in trading. Now, let's talk about the framework for a successful trader, where a consistently profitable trader have positive results over the long run, and you want to model their success strategy. So the first thing, as let's say a newcomer, right, as a beginner, when you know nothing about trading, the first thing that you would do is actually acquire knowledge. Knowledge is the first thing that you must have about trading. You need to learn, where you continuously do your learning and build your knowledge about trading and understanding about the market fundamentals, technical analysis, and any knowledge that helps you in trading. And the next thing you would do would be you build and develop your trading strategy and systems based on your knowledge and understanding about the market. So the key point here is understanding about the trading strategy you use. Once you understand your strategy well, eventually and automatically, you already have developed a good trading psychology. Okay, so if you actually copy and paste, or you just duplicate other people's trading strategy without any understanding, right? Also automatically you do not have good trading psychology. Why? Because you don't have the knowledge to execute those particular strategy. Now, with the knowledge and strategy you have, the next thing you do is, of course, you analyze the market and then you trade. So after you take a trading position or place an order in the market, you will be dealing with the outcomes of your trading decision. You will actually get the fruit immediately, whether is it making money or actually losing money from trading. So successful and profitable traders, in fact, they know how to deal with the outcomes effectively, whether they make money or whether do they lose money. While those who are not quite successful, those who are still continuously losing money, for those who are still finding their way to be a better trader, they do not know how to deal with those outcomes effectively. Maybe they haven't learned how to cope up with situations, especially during losing period. Maybe they haven't found effective ways to deal with what works for them yet. Okay, so I would assume you haven't, for you, your case, right? Most of you haven't found an effective way to cope up with losses yet. So as you can see here, throughout the whole process, it involves your psychology, right? It involves your mind, it involves your behaviors, it involves your emotions. And remember, this is actually a general framework only, and this framework explains the whole process of your trading. Every single person will go through this process. So today, I will be sharing with you specifically on how to deal with the trading outcomes, especially when you lose money. In fact, in good markets, right, when making money, most people are unable to see problems or areas of improvement in their trading approach. However, when it comes to difficult market situations, especially when the market is difficult to trade or changes in trend, so that's where most people experiencing trading losses. So in short, during good times, almost everyone can call themselves as being talented in trading or declare themselves as a successful trader already. But only during tough times and difficult times, only we can see who is really good and can survive in the market. And most importantly for you is that you need to be able to manage your losing period in trading so that you can thrive and make a strong comeback. Now that you have already understand what trading psychology is, in this topic, I'm going to share with you the four main types of losses that most people experience in their trading. Now let's have a look at this chart. So x-axis, this is where you trade across time, and the y-axis is actually your profit and loss, how much you make in your trading. And this yellow line is actually your equity curve, your accumulated profit and loss. So for example, along the way when you trade, right, you have reached a point where you have a trading profit of, for example, 20,000. it can be a realized profit or unrealized profit. And somewhere along the line in your trading, it can be, price comes down, or you encounter a situation where you face a streak of losses. So you trade, you lose money, you trade and you lose money again. So now let's say your total profit now remains 14,000 in profit, okay? So now take note of this. This is actually a critical stage for every trader, right? So now from earlier period, right, you have already made money and now you lose money, right? So it's a very critical stage for you. If you are not able to manage your trading psychology well in this stage, you may be doing a lot of stupid things in trading that you will later on may regret and cause your trading account to go down even further. If you are able to manage your trading psychology effectively, when you manage your emotions and thinking well, and focus on your trading plan and stick to your trading strategy. And if the market condition allows, you will actually see your trading profit to rise again, okay? And your trading account continue to grow. Now, my question to you is this, very simple. First, I would like to know, what is trading losses mean to you? So you just need to type in the keywords in the chat box. What is trading losses mean to you? So when it comes to trading losses, what comes into your mind first? Okay, let me know in the chat box. I give you some time to type in your keywords in the chat box. Later on, I'm going to share and reveal the answer to you. And trading losses, a lot of people have different definitions about trading losses. Some people see losses in very, very different way. So later on, I'm going to reveal the answer to you about how most traders would actually see trading losses. And in fact, some of the losses are real. Some of the losses is not a real loss. It's just only a psychological loss only. Okay, so let me see what you have put in your chat box here. So some of you would say trading losses is actually trading business costs. Some would say losing money, cost of trading, losses of a decision, price comes down, exit price less than entry price. Some would be saying paper or unrealized loss, losing on paper, shrinking of trading account, loss more than 30% lost capital or capital drops. Okay, so some of you has already hit some of the points. So later on in the next few slides, I'm going to share with you some of the losses, right? You don't consider as real losses, but in fact it is a psychological losses that actually affects your trading psychology very much. So here already you can see in the chat box itself, different people have different definitions about trading losses. So let's have a look at what trading losses is. In fact, trading losses can come in many, many different forms, okay? Not just only referring to losing money. So later on, I'm going to share with you 4 main categories of trading losses, and you'll see which of these categories actually suits you or describe you best a lot. Now, most people, they trading losses in many of these ways. Some of it are psychological losses, which means it is not a real loss, but you feel like you are losing money already. Okay, so I repeat, there are generally two types of losses. One is the real monetary loss, and another one is the psychological loss. Psychological loss means is that it is not a real loss. You don't lose money there, but you feel like you lose money already. Okay, so let's have a look. There are 4 types of losses. So type number 1, the first one is actually you really, really lose money. Most people would refer losses to, we have unrealized losses and even realized losses. Unrealized losses means that it is a negative figure in your trading account, which you may be reluctant to cut your losses or realize. And your realized losses would be you have already closed your position and take the losses. Any trades that are negative and reduce your trading account value are considered as losing money. So here, type 1 of losses, it's very easy to understand. Most people understand this. And the subsequent losses which I'm going to share with you, you will probably know and even experience yourself personally already. So these there are times you may even see these few cases as trading losses as well. So type 2 of losses is actually you have lesser profit. Okay, you might be wonder how come lesser profit. Some people would also perceive this as even losses, correct? So some people would perceive having a lesser profit as losing money that they could have earned. So let me give you an example. For example, now that you have already have an unrealized profit of 10,000, right? So you want to let your profit run a little bit longer. So a few days later, by the time you have decided to take your profit, or you follow your trading strategy to take profit, your realized profit is only 7,000. Okay, so initially you have 10,000 unrealized profit. Now when you close your position, you have a realized profit of 7,000. So this is a pretty good trade, right? It's actually making money, 7,000. Somehow or other, some traders, they are not quite comfortable with it. They think that if they were to take profit earlier on, right, or make decisions sooner, they would have locked in the 10,000 profit earlier. So now that instead of making 10,000 in profit, now they make 7,000 in profit. So they would see this as a loss of $3,000. So this is an example of taking profit too late. Another example is when traders take profit too early so that they can lock in the profit immediately. So you may have, for example, currently you have an unrealized profit of 10,000. So you choose to take profit immediately. But the market goes up even further and giving you an additional, let's say, $10,000. So you may be thinking again, if you were to let your profits run, right, you would have made that 20,000 instead. So here you can see for type 2 losses, if you have trading profit, but you treat it as a trading losses because you are looking at losses from a different angle that you could have earned. Okay, so this is type 2 losses. Now, type 3 losses is actually the fear of missing out, missing trading opportunities. So this is where a lot of people have this fear of missing out. In short, we call it the FOMO. So you're afraid that you lose trading opportunities. So even though your trading plan, for example, does not suggest you to even take a trade, your trading system does not show you any trading signal yet. Because of this FOMO, you have the urge to get into the market. So what happens next is that if you are lucky, right, of course you make money, but most people would give themselves credit for being skillful, even though you make money and not following your own trading plan. So as you know, trading is actually over the long run, right? It's not about luck. You may run out of luck someday, right? But you can never run out of skill. So some trader treat this FOMO as a loss as well, because if you don't take that position, right, even though your trading system does not suggest you, they are afraid of losing the potential trading opportunities. So this is the type 3 of losses. And the last one, the type 4 loss, is actually when you compare with other people who have a better performance with you. So I believe some of you might be comparing with your friends or someone else, right? So let me give you an example here. So let's say you have already made 5,000 using strategy A, while your friend make $8,000 using strategy B. You are feeling unhappy, so you intend to actually switch to strategy B. Then you see another friend using strategy C, making even more money than you. So you switch to strategy again. So similar to type 2 losses, right? You feel that having lesser profit means losing the opportunity to make money you think you could have made. So the challenge here is that you are switching to a strategy that you are totally unfamiliar with. Okay, can you get that? You are actually switching strategy that you are totally not familiar with, you are switching to a strategy that you have no knowledge in. Okay, and this can be a risky trade. So you can see all of these 4 types of trading losses. Type number 1 is actually real losses. Type number 2, 3, and 4 are actually psychological losses. It's not a real loss. It's only how you perceive it, and it can be very, very dangerous. And you can see all of these are just a common phenomena of what happened in your trading activities. So in short, in this page, what I want to highlight to you is that different people perceive losses very, very differently. Most unsuccessful trader, they are when they face losses, what do they do is that they would do this thing. They would do something that is out of their trading plan and their training system. They even break their trading rules and don't follow their rules at all. They are doing something that out of their competency. So I believe this is something that you are pretty familiar with, and you may even experience it before from time to time. In fact, this is actually a very, very dangerous practice. So I encourage you to actually spot yourself. You need to catch yourself whether you're actually doing this thing where you're actually doing something out of your trading plan. Because when you're doing something out of your trading plan, you are not familiar with the territory out there. So out of your trading plan means that you are doing something you are not familiar with. Why? Because number 1, you lack of knowledge about the strategy as well as the situation. Number 2 is that you did not test the strategy well enough, so you are not quite sure how it would actually perform during the past. You also do not really know how to enter or even exit the trade. You maybe enter the trade already, but you do not know how to exit the trade. You do not really know how to cut loss if, let's say, things go wrong. And you also do not you do not understand the strategy well. So it's actually a very, very high risk trade. So in short, you are putting yourself at a great disadvantage position to trade. So meaning you are putting yourself in a high risk situation that you do not know how to manage. And the chances of winning is actually very slim, and the probability of losing is very high. And no wonder you can see that majority of people who trade out of their plan, they can't survive in the market over the long run. In the short run, maybe you can gain some profit here and there based on luck, but over the long run, the market will test on your trading skills as well as your competency. So you need to understand that losing money in market is actually normal and unavoidable. You need to accept the reality and be comfortable with it so that you don't let any of these situations affect your trading psychology as well as your judgment for your next subsequent trade. So what do traders do when they face losses is that they would have this mentality, how can I cope or how can I cover my trading losses as fast as possible? And they get carried away from focusing on their trading plan, and they begin to think how to cover their trading losses in the shortest period of time. So does that sound familiar to you? So if it's very familiar to you, you can type in yes in the chat box. Just admit it, because it's important to admit your mistakes, then let you continuing to do your mistakes and let it run without having awareness at all. Because later on I'm going to share with you, admitting mistake is actually very, very important thing, especially guys, especially guys, I mean men's, boys, or guys, they are very hard to admit mistakes when it comes to trading. For ladies, it's easy for them, but for guys, because of ego or hormones, it's very hard for us to admit our mistakes. So back to trading here. A lot of traders they want to cover their losses fast. So what do they do is that here are a few common big mistakes that most traders actually commit. So number 1 is excessive trading. You overtrade, you trade too much. Second one is you overtrade, where you trade too big of a contract size. You take risky trades, and you may be a little bit aggressive in your trading with a hope that, you know, if you were to trade more or trade bigger in order to, you know, make profit to cover back on your losses. And you also attempt to pick market top and market bottom. So here you can see that all of these mistakes, right, ultimately it leads you to high probability of losing and leading your trading account to blow up very, very fast. So all of these things you need to be able to have the awareness as well as catch yourself which of these mistakes that you actually do when you face after you face trading losses. Now, of course, trading losses, to put it in simple words, right? Let me summarize this. Trading losses, to put it in simple words, when you face trading losses, if you do not know how to manage your trading psychology effectively, what you would do the next thing is that you do something out of your trading plan, okay, with a hope to make money and cover your trading losses, which eventually may cause you even greater losses. And then you repeat the same thing all over again, and the cycle continues. So you need to stop this loop. You need to stop this cycle. It is very, very important to have the awareness when you commit all of these dangerous behavior, okay? So by learning how to cope up with trading losses and managing your psychology effectively and trade according to your plan. Now, let's go through the third topic, the 5 stages of dealing with trading losses. This is very important when it comes to experiencing trading losses, because these are the 5 stages most people will actually go through. And these 5 stages, in fact, it is not my model. It is actually a very popular and common model used in terms of explaining grief and loss. So these 5 stages was originally developed by Kubler-Ross, a Swiss American psychiatrist. It is a very, very popular and widely used in describing the stages people go through when they lose their loved ones or something that is important to them. And why? Because this model is actually easy to understand and can also be applied to trading as well. Because you are losing your hard-earned money, you are actually separated from your money. So you will be experiencing grief and loss. And this model is actually quite useful in helping you to understand how other people actually cope up with the changes, okay? So when you're experiencing trading losses, first you will be denial about your loss. Then you are angry with it. You want to bargain to have lesser losses. Then you feel depressed. And then later on, until and unless you are able to accept the reality that you are in a loss already. Only then you can be okay with it and continue to move on. So I will explain each and every stages in detail in the next few slides. And of course, not everyone will experience all of these 5 stages. Some people go through these stages a little bit more quickly. So the first stage is denial. Of course, this first stage is when the initial stage of having minor losses. You do not want to cut your losses short. So in fact, even though you have, initially you have profit already, now you have a reduced profit and you still continue want to hold on it, and you deny that, the trend has already changed. So here, you ignore the fact that the market has already changed. You affirm yourself that this is just only a small market pullback and will bounce back soon. So you don't bother to cut your losses or even follow your trading system to take profit or cut loss. So this is where you continue to find information to prove that you are still correct. You ignore the fact that has already shown you already in the market, so that you don't look stupid, or this fact, those new information, new fact might even hurt your ego. So you ignore it. You are in a denial. So you don't really take it seriously because it is just only small losses, no problem with it. So even though your trading indicator or your trading strategy has already shown you that the market has already change direction or change trend already, you are reluctant to switch your position or to a different direction, because futures you can, after you long you can short, after you short you can long again, right? Unlike stocks, you are reluctant to cut your losses. So because of that, you do not want to admit that you are wrong. So you continue to be in denial in order to protect yourself. You do not want your ego to be hurt. So this is where you come to the next stage, which is the second stage, is anger. So now take note that in this stage, this is very important here. Most people make a very big mistake in this stage. In fact, you may be able to commit further mistake. It can be a double or even triple mistakes that can cause you further losses. So listen to this correctly, okay? Because of the initial stage of denial, you are now having a small trading losses. And again, you are also denial that you don't believe the market trend has already changed. So in order to cover back your previous losses, what do? You may be averaging down, or you may be even betting bigger, hoping that the market can actually rebound, so that when you can cover back all of your trading losses quickly with profit. So this is where you will be attempting to take revenge in the market. So you commit over trading, trading too big, taking risky trades for the purpose of covering your losses. So stage one, you already make a mistake, so you do not want to admit your mistake. Now in stage two, you have already committed the second mistake that would actually amplify your first mistake even bigger. So when you are making losses in trading, you need to be able to detect and catch yourself from committing this error, okay? So that you don't commit even more mistakes that can actually magnify your losses. Now the third stage is bargaining. In this stage, you may be having big losses, so big enough that you can actually feel the pressure, the pain, and the stress already. You can't take it anymore. So here you begin to start praying the market to go back to the level near to your entry point, so that you can have lesser losses. You may be praying that if the price comes back to break even, maybe you can consider to close your position. If the price comes back, if you lose lesser, then you can actually cut your losses smaller. So here you will be sitting hoping for unrealistic events to happen, even though you know that the trend will continue. The trend, in order to reverses back, right, it takes some time. So here you are still bargaining, because almost you are actually quite about there of losing hope. So this is where you will be coming to stage number 4, which is what we call the depression stage. So after some time of bargaining, you don't have energy, you don't have strength to bargain anymore, because the market does not move the way in your favor. So you continue to have even bigger losses. Your losses is too big in your account already, because you have to take that huge drawdown. You may be even feeling that you lose hope and do not want to trade anymore. You feel like giving up trading at all, because you are trading futures, right? It is different from stocks. So you may be trigger margin call, or you need to be forced to close your contract no matter what, because futures, it's about the futures contract, right? You are unable to hold until the contract expire. So here you need to face a reality lah. Okay, you need to cut your losses, or your broker will cut for you. So some people do note this, okay, take note of this. Some people, they get stuck in this stage for quite a long time. So how long do they stuck in this stage? I don't really know. Some traders, they lose a few times, and then they just decide that, okay, trading is not right for me. This completely stay away from the market completely, due to fear, even trauma, because of trading losses. Some trader, they get stuck in a depression stage for a very long time, that they take few years to actually let them resolve their fears, so that few years later they come back to the market. And some traders, they might be depressed or going through the stress that actually can affect their normal, their daily life functioning, where especially like you don't have a mood to continue to go to work anymore. You don't feel like you are completely demotivated to do anything. So in this stage, depression stage, you also need to find, it's important for you to identify when you're in this stage. So here you need to give yourself time to settle down your negative emotions. And lastly, stage number 5 is on acceptance. Until and unless you are able to accept that you commit mistakes and you are wrong in the market, then you are able to make a comeback. So in this stage, your emotions begin to stabilize a little bit. You are stable down and you re-enter into a reality already. You come to terms with the fact that the reality is that you can't change the fact that you are already having trading losses. You accept the fact that, okay, I did wrong in my trading strategy. I execute my trading wrongly. I did not follow my trading system correctly. So you are now facing the consequences of trading losses. So there's nothing much you can actually do about it. But here in this stage 5, you're actually okay with that. You accept the fact already. So here you need to learn how to live with the losses, because losses is already it's already a reality. Okay, it's actually already a fact. So it's definitely a time for you to make some adjustment and readjustments. You need to understand the nature of the market and learn the new reality about the market. So here you are ready to actually learn from your past mistakes and exploring better options and solutions to solve your issues and move on in your trading. So these 5 stages are just only a brief explanation, and it's pretty easy for most people to understand, because not everyone will experience all of these 5 stages, because these 5 stages is only a guideline. What I would like to highlight to you is that the faster you can proceed through in coping up with these 5 stages, the better you can actually focus on your trading process and improve your trading results. In other words, if you want to shorten your learning curve in trading, you can actually pick any of these one aspect you can improve on in your trading. By shortening the time you deal with trading losses, you need to find effective ways to deal with losses, because some of the people, right, they take very long time to to feel anger. For example, they take too long time in terms of feeling depressed about the market. So this is why they let their losses to roll even bigger. So in fact, if you're able to go through these stages of accepting losses very quickly, and then just cut your losses and then move on and focus on the next trade, that would be the ideal best practice that you would want to do in your trading. Now, the last thing is that I would like to share with you, once you are able to identify trading losses, once you are aware of the psychological process that you are going through, then you need to learn how to deal with it so that you can actually get back on your feet, stand back up, and then continue to move forward, because that is ultimately what you want, right? You come to trading because you have some goals that you would want to achieve, especially financial related goals. So of course, in trading, you may experience some or many different types of emotions during periods of losses. There are more emotions to this list at different range, as well as at varying degrees. It is normal for you to feel any of these emotions. For me, from time to time, I feel any of these emotions as well. The most important thing is that you deal with those emotions, so that these emotions do not disrupt your thinking, and so that they do not affect your thinking. It does not affect your judgment and decision making. Okay, now remember this: Although you may have been defeated in small losses, but as long as you protect your trading account, as long as you preserve your wealth, you still have a chance to make a comeback and have the opportunity to trade. Losing traders, they want to win the battle because of ego, right? They can't admit of themselves being wrong. They want to be right in every single trade. So that's why they end up in, blowing up their trading account. So what you can do is quickly admit your mistakes and limit your losses and survive first so that you can actually trade for another day. Okay, so if you receive this message and you understand this very important message already, type in yes in the comment box so that I know you are able to admit that it's important for you to focus on the big picture. It's okay to take small losses and continue to move on, because ultimately small losses is actually a small cost of doing the business of trading. It's okay to have small losses, and all you need to do is focus on the big picture. As long as you have money in your trading account, sufficient money to trade, you can still make a comeback. Okay, now in fact, when it comes to trading, right, not every trade works out. You should expect things to go wrong from time to time, even if you have the best trading system. Okay, do expect things to go wrong from time to time, and have a plan for it when it actually happens, which is why you need to have a good risk management in terms of getting out of the market, even though you feel that the market is already wrong already. You need to get out from the market to protect yourself. So this means that do expect mistakes, do expect that you are going to have bad luck in trading. I do have bad luck in trading as well, and also do expect to be wrong about your judgment. Okay, so when things go wrong, learn to cut your losses short, cut your losses quickly, and to do that you must be willing to take a loss. Okay, to do that you must be willing to take a loss, because losses are part and parcel of trading, because the goal of cutting losses is actually to avoid watching smaller losses to actually getting into bigger losses. Okay, the goal of cutting losses is to avoid watching your small losses turning into big loss. And most people do not want to cut loss because of fear. They do not want to regret of cutting losses and then the market bounce back up, or they feel too painful to cut, and they do not want to admit, and most importantly they do not want to admit that they are in a wrong to to protect their ego. Okay, so remember early on, cut losses is actually to focus on the bigger picture so that you can actually still have bargaining chips to continue to trade in the market. So here are several strategies for you to deal with losses. You can actually still use back this same think, feel, and do model to cope up with losses, because as I've already shared with you, trading psychology, it deals with these three main key components, which is how you think, um, how you feel, and what you do. Okay, so the first thing, let's start with your mind first, your thinking. um, you need to learn, you need to relearn and even revise your knowledge, because most of the time the knowledge that you currently have right now, okay, is actually incomplete or not comprehensive and deep enough. Okay, so it is actually I believe you heard this term is called constant and never ending improvement, or continuing education, right? So it is a process that you need to continuously learn and improve yourself to understand the market better. So sometimes the knowledge that you have about trading is actually incorrect. So you need to continue to correct it as well as revise it. So you do remember, continue to never stop learning in trading and revise your knowledge. This is very, very important. Now, the next thing that you can do is to revise your trading plan. Okay, so once you revise your knowledge already, now with the new knowledge, you can actually revise your trading plan. So what it does mean is that what does revise your trading plan actually means is that it does not necessarily mean change your whole trading strategy and system. Okay, sometimes you just need to understand your trading strategy a little bit more in depth. Okay, because it can be a time when your trading strategy does not work in the short run, and when the market condition allows your trading strategy function better again. Okay, so which is why you need to understand your trading strategy a little bit more in depth and understand your trading strategy very well. And sometimes you might just need to backtest your strategy again, because sometimes your trading strategy might not work anymore. So you need to find other strategies that actually works. Another thing that you can do is when you encounter trading losses is to do your trading journal. Now, how many of you here do record and review your trades here? Type in yes in the chat box. Okay, how many of you here do record and review your trades? If you don't do any record, you can type in no. It's okay. Just admit that you did not do your trading journal. Because trading journal is actually one of a very important thing that you actually write down. Even though you don't review your trade, it's okay. Okay, I repeat, even though if you don't review your trade, it's okay. But as the most important thing for trading journal, that number one thing is at least you have a record of what you do in your past trading. If you don't have any record, you can't even trace back what you did previously. Am I right? Because you just really can't rely on your memory. So if you do not record your past trades, then it is very hard for you to actually make a review or even make reflection or even make improvements on your trading strategy. So trading journal is important to hold you accountable for what you have done in your past. So you can see that this is actually one of the important behavior, but a lot of people they are quite reluctant to do their trading journal because it actually takes time to do trading journal. It takes a little bit discipline, but the result can be actually very rewarding if you do actually do your trading journal. Okay, so you need to be aware of this thing when you do your trading journal. Okay. And the last thing is actually on emotions. In fact, emotions is something on emotional management. So what it means is that I understand facing losses is definitely challenging. It's never been easy. Even professionals do face trading losses from time to time. Okay, you can see all of those, professional money managers and fund managers, especially hedge fund managers, they face trading losses from time to time. It's never been easy. It comes with stress as well as anxiety. So cut losses is, in short, cut your losses short is important because you don't have to face huge losses that would actually have even a huge emotional impact on you. Okay, because you will never know whether if your losses can turn into bigger losses. So when you have losses, just get out of the market, take a rest so that you actually think clearly before you would want to enter the market again. Okay, big losses definitely will have a big emotional impact on you. So you need to be aware of yourself when you have small losses. You need to find effective ways to cope up with stress and anxiety. How to do that, how to cope up with stress and anxiety, you can actually Google it, find whichever ways that actually suits you. Why I am unable to advise you on this is because different people have a different coping style, and different people, they cope up with stress and anxiety very differently. So for example, some people would choose to take a walk in the garden. Some people would choose to go to gym, have a run, eat ice cream, eat chocolates, or even go to a sleep. So you need to discover what works for you best. But for emotional management here, it is best for you to just cut your losses first and only deal with your emotions. Okay, a lot of people deal with emotion first, then only choose whether to cut your losses, because that would be a very reverse way already. Because if you deal with your emotions, then only to decide whether to cut your losses, then it might be already too late. So the best thing would be actually take a small losses, get out from the market first, and then later on deal with your emotions, because ultimately you do not want your losses, small losses, to turn big. Okay, now here you can see of all of these 4 strategies, right? These 4 main strategies, I suggest you to do the first 3 strategies first. Okay, number 1, number 2, and number 3. Why? Because once you have done number 1, 2, and number 3, once you have done 1, 2, and 3, number 4 would have already solved halfway. Okay, once you have a good solid understanding about the market, once you have a good trading plan and a trading strategy, you already can you can already decide to the next round when you trade, you already know when to get out of the market even when you have losses. Okay, so does that make sense to you already? Do number 1 and number 2 and number 3 first. Number 4, do make it the last one that for you to do. Once you do number 1, 2, and 3, number 4 would have already solved halfway. Now, before I end, let me share with you this. Another approach of dealing with trading losses is actually just to stop trading. Okay, cut your losses, get out from the market, and just to stop trading. And it's okay to stop trading. All right, because take a step back, take a step away from trading. Don't look at the market. Take a break. Okay, there is no shame from stop trading. Okay, I repeat again, there is no shame from stop trading. Okay, don't let your ego to to push you to continue to trade. It's okay to stop trading. It's okay to let go of opportunities, because nobody is going to laugh at you. Nobody even knows you stop trading. All the key thing is that always preserve your trading capital so that you can actually trade for another day. Okay, have a good rest when your mind is clear enough, when you rebuild your knowledge, when you revise your trading strategy, when you're comfortable, you can always come back to the market when you are ready. Okay, if you lose all of your capital, then you don't even have a chance to make a comeback. So always preserve your trading capital first, rather than letting your ego to push you continually to trade. Okay, it's okay to stop trading. And lastly, as you know that trading and investing is actually very different from any other methods of making money. Why? Because you just can't force the market to bend to the direction of your liking, right? So always focus on the process and not the outcome. The outcome and the result will actually take care of itself. All you need to do is actually focus on following your trading plan strictly. When it's time to take profit, just take your profit and be comfortable whenever whatever profit that you get. Okay, when it's time to take profit, just take a profit and be comfortable with whatever profit you get. Okay, don't take it as a loss. And whenever it's time to cut losses, don't hesitate, immediately cut your losses. Don't hesitate too long. Okay, and also be comfortable whatever losses that you take also, because losses is actually once you take your losses, it's already closed case okay. Does that make sense? Once you take your losses, it's already closed case, you're out from the market. So this is where you can take your time to think and analyze whatever that you do is correct or incorrect. So it's okay for you to stop trading. It's okay for you to get out of the market with no position, for you to actually clear your mind so that you have a better thinking, so that you have a better trading psychology when you come back to the market. Okay, so let me summarize for today's 4 key points. So trading psychology, there is 3 key components. Can you remember? Simply speaking, very simple: mind, behavior, and emotions. Or in other words, it's actually what you think, what you feel, and the things that you do. Okay, think, feel, and do. The second thing is that there are different types of trading losses. There are realized loss and unrealized loss. Those are actually real monetary loss. And of course, there are also psychological losses. It is best to avoid having to perceive the market as having having psychological losses, because all of those are not real losses. All of those are actually in fact, to make it simple, words, right? It is a losses. Psychological losses are actually losses that actually tricks your mind to trade even more in a market. Okay, so eliminate or reduce as much as you can on the psychological losses. So you need to learn how to go through the 5 stages effectively. The sooner you are able to go through these 5 stages, the better it is for you. And lastly, developing trading psychology means you need to develop what? Your thinking, your behavior, as well as your emotions. So of course, the first thing is actually develop your knowledge, build your knowledge, revise your trading plan, do your trading journal, revise your trading strategies, as well as find ways to manage your emotion better. Okay, so that's it for today for my sharing about the ways on how you can deal with your trading losses.